Hello, this is Arlan Suderman, Chief Commodities Economist at StoneX, and it's great to be with you once again for another one of our crop report webinars. And so with that being said, let's go ahead and get started. First of all, give you a chance to read through our disclaimer. And today's crop report didn't have too many surprises, but there were some key ones that we want to talk about and the impact. And we also want to talk about what's happening in the outside markets and in the economy, and that's affecting money flow. And I think it's going to take on and really kind of go on the way we've talked about, we anticipated. And that's playing out now. So let's go ahead and get into it, because price is a function of supply and demand as modified by the flow of money. And as we look at what the Federal Reserve has done, it continues to pause on the interest rate hikes or cuts, not doing anything now for quite some time. And as we look at that, we almost have to ask, did they pause their rate hikes too soon? Because once they paused their rate hikes, we started seeing the decline in inflation come to a pause as well. And we've been chopping sideways. As you see on the right-hand side of this graphic, headline CPI took a turn upward. Last month, it was a slight turn upward. This month, it was a little bit more significant turn upward. So now we're closer to the 4% level than we are the 3% level. And of course, that's well above, well, let me correct that. I'm looking at the graph, closer to the 4% level than we are to the Fed's 2% mandate level. And so if you look at the economic data that came out this past week, first of all, to cut rates now would only enhance the reinflation pressures that we're seeing. And second of all, the economy is not screaming at the Fed to cut rates. The economy is continuing to go forward. And in fact, I'm going to show you a couple of slides here that show that, in fact, let's just move into that right now, that starting with the December meeting, when the Fed started talking about pivoting, that was enough to get consumer confidence comes back. This actually comes from data from the Conference Board, which does our consumer sentiment survey for the country. And you can see there that the number of respondents feeling good about the labor market took a turn upward as soon as the Fed started talking about the possibility of cutting rates. And just another indicator that they say it takes 12 to 18 months for Fed rate hikes to really be felt in the economy, but all they have to do is start talking about rate cuts to be felt in the economy, and it acts as a stimulus to the economy overall. So let's look here at what's happening in the housing market, because we saw in the CPI that higher shelter costs, housing costs, were one of the key factors in this inflation number, which has been all along, but a significant one here as well. And what we see in our housing sector is that we continue to have a shortage of housing in this market. So whenever consumer sentiment improves and or we get a dip in interest rates, we see demand for homes go up. But the bulk of the houses, we had near zero interest rates for so long, the bulk of the homes have mortgage in the United States have mortgages now that are below 4%, with a large portion below 3%. And so they have no interest in selling their house and taking a new house with a new loan at a higher interest rate. And so where are these new houses coming from? They're coming from brand new construction. And so you see here the trend higher for the percentage of homes being sold that are brand new homes is rising, because those who have houses with 3 and 4% mortgages don't want to let go of them. They don't want to let go of that good thing that they have. Now, let's look here at the graphic that we've been showing you. And that graphic keeps sliding up on the title every time when we load it up here. So that's an interesting thing that's happening. I apologize for that. But if we focus on the right-hand side, and I've talked about this chart many times before, the dark blue line is our our basket of commodities, our StoneX commodity tracker. You see how it's slowly tracking higher on the right-hand side of the graphic. This covers 10 years here on this graphic. And the correlation between this and the 5-year break-even inflation rate, which is what the market believes inflation is going to average over the next 5 years, is at 0.87. And statistically, anything above a 0.70 is a strong correlation. And so both the value of the commodities and the U.S. 5-year break-even inflation rate are slowly trending higher. Now, the 5-year break-even inflation rate is getting up there close to 2.5%, getting away from that 2% mandate level. It's still not enough, I don't believe yet. I think it'd be premature to say this is going to flip the funds to want to own the commodities from being short to commodities, being long commodities. And granted, they are long some commodities that have a story, but their overall default mode for the commodity sector as a whole is to be short right now. And so, but when we look at the commodities as a whole, they are trending higher. Now, they're still below that previous peak, so we wouldn't call this a breakout by any means. Maybe this is just continuation of the sideways pattern, but this is something we're going to continue to monitor as we go forward. When you look at the 2-year break-even inflation rate, so this is StoneX commodity tracker versus the 2-year break-even inflation rate, that has a stronger tone to it, getting up there close to that 3% level. And that fits with some of the other consumer surveys we've seen as well. And the 1 year is even stronger, the 1-year measurements of inflation. So this gives us an idea that we're moving in the direction that I've been saying for the last 6 months that I felt like we would move come the second and third quarter of this year. So why is that significant? Because as you see in the correlation on the 2 years, 0.85, historically, whenever inflation expectations go higher, the managed money has preferred to be long rather than short. And right now they're short. And so that's why it matters. Now, if the fundamentals are still bearish and we have carry in the market, they also love to sell that carry. So this is going to be interesting to see how this plays out. But based on history, they prefer to be long. How does it relate to CPI, Consumer Price Index, as well? 0.88. Pretty strong correlation there. And you see there the rise in the CPI that we had in the last report. If we look at the grain and oilseed sub-trackers, just specifically that sector, also correlation of 0.88. So pretty strong correlation there with the CPI. Now let's look at geopolitical risks. Yeah, the war in Ukraine, unfortunately, still continuing to move forward. Russia now calling it a war, as I pointed out in the March 28th webinar after the quarterly stocks and planning intentions report. That's a change in terminology that has significance, allows them to call up more draftees. It allows them to get better support for the operation from the public. Now, Ukraine continues to strike oil and military facilities deep inside of Russia because Ukraine now has better technology available to it provided by the West. Russia is retaliating by escalating the strikes on Ukrainian energy and port infrastructure. If they wanted to, I would say, you would think that if they wanted to totally wipe out those port facilities, they could. So does this mean that they're kind of used in some restraint, expecting that they're going to win this war and therefore they want to have those port facilities intact for exporting the grain that's grown on the rich soils of Ukraine? Or is it that they don't have as much capability as what we think? I don't have the answer to that, but it makes a good question to consider. Now, they have inflicted quite a bit more damage in recent weeks on those port facilities, particularly at Odessa. And so as I was monitoring the data, I thought that it would show that March exports had decreased. And when we look at the data, it does show a very modest decline, but it's very modest. very modest. And overall, exports are very close to what they were pre-war. And so grain continues to flow, and particularly for wheat and to some extent corn, that's one of the reasons prices are really struggling to sustain any type of a rally right now between Russia and Ukrainian exports trying to race each other to the bottom. Now, we've seen Russia slowly firm its prices as it's challenging a couple of its private exporters, which we believe is its efforts to really kind of take control of all of the exports coming out of Russia. Is that, is it going to weaponize those exports then, the food exports, or just feel like it can get a control over them better? But in the meantime, we continue to see a lot of grain flowing out of the Black Sea for now. You have to wonder what would happen if the unthinkable would happen and we'd have a ship sunk. That's a risk to this market that we need to continue to monitor. And if ships no longer feel safe, for now, they feel safe enough, shall we say, to go into the ports from both Ukraine and Russia to get the commodities and to go out with them. And if that changes, then the markets will reflect that. You would expect it to do so. As for China, Taiwan remains the potential black swan event there. But meanwhile, we continue to see trade struggle. As I've talked about at the March 28 event, if you look at that peak soybean export window, where we export our most beans each year to China, October to February, this year Chinese imports of U.S. beans during that window were down 10 million metric tons, while Chinese imports of Brazilian beans were up 12 million metric tons. Now, some of it's political, but let's keep in mind that they're also very price conscious and always have been. And for most of that time, Brazil soybeans were cheaper than U.S. soybeans. That's not discounting the tensions between China and the United States and the West, but it is saying that it is a significant factor we need to respect as well. Middle East, Red Sea continues to be a problem, particularly since last month's webinar. We saw Israel strike a couple of key targets in Syria that killed key military leaders, Iranian military leaders. So Iran has promised revenge onto Israel. Nobody knows what form that revenge will take. I don't believe that Iran wants a war with the United States, but they feel like they have to do something. So the question is, will the United States stand by Israel or not? Or the bigger question is, does Iran believe that the United States will stand by Israel or not? The key here is, does this spread to a more regional war that would start risking damage to crude oil production and export infrastructure? And that's part of the key, as well as add to the current risks of any cargo ships moving through the Red Sea and the Suez Canal. That's one of the key questions, particularly at a time when movement through the Panama Canal remains limited, at least for another month or two. We do anticipate that improving. Now, these added shipping costs are adding to inflation. We've already seen this, particularly a tightness of container, raising the cost of containers because they're on the water longer, because they have to go all the way around South America, all the way around Africa because of these two problems with the Suez Canal and the Panama Canal. And therefore, they're on the water longer, so therefore there's a limited number of containers available. Now, here you can see the Panama Canal problems as it plays out. We see the higher water levels in 2022, and then those water levels started to drop in the winter and spring of 2023 to where they were very low in the summer and fall of last year. And we saw that play out with fewer cargoes be able to go through the Panama Canal. Now, I was at the Panama Canal this last week to see firsthand. They are very optimistic that the seasonal rains will increase starting at some point next month, maybe about a month from now. It was interesting to see the day that I went to the Panama Canal on Tuesday, we had some tropical storms go through, not the typical, not type of tropical storms, that turn into hurricanes, but tropical thunderstorm activity. Maybe I should say that they got a good heavy rain that day, but they need a lot more. Each ship that goes through that canal requires 55 million gallons of water out of the Gatun Lake. So they need a lot of rain. And the rainy season seasonally starts up in May again. And so far, the models are indicating that that's going to happen. And if we continue to flip toward La Nina, the expectation is that that's going to enhance the rains. So the people at the Panama Canal Authority are cautiously optimistic that we're getting close to fixing this problem with the Panama Canal. And I know there's certainly a lot of people that hope that that is the case. And I guess this just kind of, I've already covered this material, and you see a picture that I took here of this being a crude oil tanker moving through the canal on Tuesday of this week. Okay, let's talk about weather. Again, our winter was one of the most mild on record of the last 132 years up in the northwestern Midwest. Great Lakes area into the northwestern Midwest, very mild. Drier in that area as well. You see, it's been pretty wet. This is looking at January through March. Pretty wet in the south and up the eastern seaboard, with a few exceptions. Overall, wet in the west as well. So where are we going from here? First of all, let's look at soil moisture levels as measured by satellites. And you see the graphic on the left where we were on January 1st, the start of the year. And frankly, it was pretty dry up the Mississippi River watershed. That pretty well covers it. And we saw those low water levels negatively impacting barge traffic on the watershed for the Mississippi and the Ohio rivers. We're in a much better position as of yesterday when I created the map on the right. Do we still have some problem areas? Yes, the Mid-South is one of those areas, but the Mid-South got some good rains yesterday, and more rains are expected here over the next week to 10 days. In fact, most of those areas that still have deficits are expected to get some moisture to further erode this down over the coming week. So let's hope that happens. In the South, we're getting almost too wet, and that's been interfering with planting of the crops. And that's something we're going to have to monitor. I even heard today complaints about, let's cut off the rain a little bit in Illinois, northern Illinois, because it's been pretty wet there. I hate to curse rain in crop growing country. So, I'm not going to do that for the time being. Okay, where are we going from here? I showed this at my March 28 webinar. Any of you who were not on there, I wanted you to see it again. This is looking at the major weather models for the ENSO cycle, the El Nino La Nina cycle, and what they expect to be the case in July. And I wanted you to see how the models disagree wildly, with NOAA expecting us to be in a moderate La Nina by July. The Canadian and the UK model are just behind that, whereas you have the Australia's Bureau of Meteorology and the Meteo are both calling for us to still be in kind of a neutral warm environment just coming out of El Nino. That has huge implications overall for where we go for the Midwest and for South America. Looking at July, the key there is going to be the U.S. Midwest. Now, as we look, again, I've shown you this before, but I want to emphasize it. So while this is an old graphic, it still holds very true. If you look on the left-hand side, it shows sea surface temperatures for the Pacific for four of the biggest droughts that we had in the Midwest over the last 35 years, 36 years, I guess we're looking at here. And each of them had colder than normal waters in the Gulf of Alaska, and then stretching from the Baja of California to Hawaii. So those are critical areas for us to watch, regardless of what the equatorial Pacific is doing. Now, the equatorial Pacific is really cooling down. We're still in a neutral warm state right now, but there's significant cold water just under the surface that is making its way upward. The other thing to watch that's different this year is all the warmth in the Atlantic, and that has some impact as well. As if we're going to get, and I guess, let me go to the next graphic here. This is a graphic that Eric Snodgrass provided with Nutrient Solutions. And if you get the cold waters that are basically up here in the Gulf of Alaska, which gives us a negative PDO, negative Pacific Decadal Oscillation Index, and then a negative PMM, which is right in here between the Baja of California and Hawaii. If you get those cold waters there, that tends to encourage low pressure in this area off the west coast. Maybe I should have drawn that just a little further west. And then you get high pressure here to the west and high pressure to the east. Now this has the Bermuda high here to the east. And then you get what's called an omega blocking high, which is right over the Midwest right here. Okay, so we have the omega high there over the Midwest in that scenario. What we ideally see is that Bermuda high down in this area, around Bermuda, and you see the winds going around it counterclockwise, pumping moisture up here in the Midwest. That if this high gets pushed over here toward Europe, then you don't get that flow of moisture up the Mississippi River area, up the Gulf Coast, up the Mississippi into the Midwest for moisture there. And so that's what we're watching for, whether we get this cold weather, cold sea surface temperatures there, and give us this blocking nature. Right now, the bias is that we will not have that, but we need to continue to watch those sea surface temperatures. There's still a little bit of a cool bias to those areas, but what really matters is going to be as we get into May and June. Okay, so what do the weather models say? If we look at the summer ensemble members, which is many, many, many runs of the European weather model with a little bit different data, we see on the left that 40% is looking for kind of patchy above to below normal rainfall across the Midwest and with a warm bias. But that scenario right there, if anything, looks a lot like 2010 for me. Now, 2010, we had high nighttime temperatures, which created some yield problems. I'm not forecasting that, but and that's not what I'm trying to say, but I'm saying it looks eerily close enough that that's something I'm going to keep an eye on. I don't think you can make a forecast for a year based on one analog year type of thing. So I don't want to do that, but it's something I'm keeping my eye on. Does this end up being like 2010? Now I talked to a weather men with the weather company at our meeting in Panama this week, and I shared that with him, and he says, 2010 is one of our analog years, so need to keep an eye on that. 34% odds that we have a little drier bias to it. That's not overly concerning to me, but it is enough to be somewhat concerning, but with more heat as well. So that's 75% odds of hot, warm to hot, and maybe either side of normal rainfall to a little bit drier to the bias. But what about if we look at month to month? And I think that matters more to us right now. So you see the upper left-hand side here, we see the outlook for May. Then it goes May, June, July, August, and September, with an overall summer summary here in the bottom in the center. And if you look at that, that's really not too bad. Warm, yes, but we can deal with that if we get enough rain and if nighttime temperatures aren't too high. That's going to be one of the keys going forward. Now, as I look at this and break down, May looks like a bias toward normal to wet. June certainly looks wet. If that would play out, we would see most areas have enough subsoil moisture. Where would I be concerned? This area from North Dakota down to western Kansas and the high plains. Texas looks to be okay. As we get into July, this still isn't overly dry, but we see this dry weather working up here from the Southwest. As we get into August, again, this really doesn't concern me for the Midwest if this plays out. It's really when we get into September that we start to see this spread, and even that's not overly much, but with the warmth there, it's something to watch. But that, frankly, by September, that helps with crop dry down for harvest. The summer as a whole doesn't look threatening to me if that plays out. Now, let's look at Brazil. This is the latest 10-day outlook from the European model. And I've circled the safrinha, the winter corn crop area here, and then Argentina's crop belt there. And as I look at this, yeah, we have some dryness in this area. There's not as much corn in that area, maybe a little bit more of an issue for the coffee crop there. But I don't, the rains are lasting longer than what the models had indicated, the longer term models. And so while a month ago I was talking about the risks for the winter corn crop, and I do think that we will see the production estimates erode lower, but I don't see anything here yet that suggests we're going to cut the size of Brazil's crop enough to boost U.S. exports, enough to justify higher prices to ration demand. So that's kind of my summary of South America right now. And Argentina is improving as well, although they're having some problems in Argentina with leaf hoppers that are spreading a disease that's stunning the corn, and that's creating some problems for the Argentine crop. So we're starting to see Argentine production estimates start to ratchet down. At this point, with neither Argentina or Brazil do we see enough of a drop in order to justify rationing demand for U.S. corn with higher prices. We'll keep our eyes on them. Not saying it won't happen, because it may happen. But at this point, I want to put that perspective on. It's not enough yet to be a factor. I did also want to show you this graphic again, showing how rains fall dramatically from March into May. This is in centimeters, or millimeters rather. So we're dropping there from better than 9 inches of rain, close to 9 inches, I should say about 8.5, 8.75 inches of rain for the month of March, down to about 3 inches of rain or so for the month of April. So we'll continue to follow that. Fundamentally, here's today's numbers from USDA. Our numbers, of course, on the bottom are estimating final numbers, with the Brazil numbers being from our customer survey. You can see that our customer survey for corn is still at 124.2 million metric tons. But as I talked to our team there, they said, you know, we don't really expect too many changes prior to the May report. By the time we get to the May report, the majority of the corn will have pollinated, and we'll have a better feel for the type of weather pattern that is set up there. Soybeans, USDA remains high. We're kind of in the middle between CONAB at 146 million metric tons and USDA at 155 million metric tons on soybeans. We're kind of in the middle there with our customer survey. Excuse me. Okay. As we look at U.S. ending stocks, USDA took its wheat number higher, a little bit higher than where I'm at, kind of between where the average, about 8 million above where the average trade guess was and 6 million above me, lowering imports by 5 million, increasing feed usage by 30 million, I believe it was, and some minor adjustments elsewhere. So we look at corn number, that came in 20 million bushels above what the average trade guess was and 90 million above where I was at. Now, of course, I'm forecasting final, not forecasting USDA. But USDA is heading in the right direction there. I continue to hold by my number and feel good about my number. On the soybeans at 340 million bushels, USDA cutting exports, finally getting down to where I've been at, but they have not raised their crush more yet. They still need to push that crush number higher. And I have that factored into my estimate with 309 million bushels. but nothing here screams that we need higher prices to ration demand. I know producers out there, you would like to have those higher prices, but I just want you to understand if we took prices higher right now, we would ration demand and result in ultimately paying a higher price for it. Global ending stocks, not a whole lot to see here, but all of them coming in, well, corn and soybeans coming in a little bit above what trade expected, wheat coming in a little bit below. Ethanol corn usage continues to run hot. USDA increasing its corn ethanol estimate by 25 million bushels. And even with that, marketing year to date, ethanol use of corn still exceeds the seasonal pace needed to be at to hit USDA's target by 98 million bushels. So we're still grinding a lot of ethanol. Plants are still operating, and USDA's got more increases in its ethanol usage estimates there to go, and therefore decreases in ending stocks. But I'm still above 2 billion bushels, so be careful, keep your bullishness contained there for now. Export shipments continue to exceed the seasonal pace needed to hit USDA's target by 50 million bushels. USDA leaving that unchanged today. China's still not buying U.S. corn. They're not buying it. They're buying from Brazil and Ukraine. In fact, they're canceling purchases from Ukraine. Simply too much. They own too much corn right now. And their storage is backing up, and they're trying to support the farmer market. And so they're canceling a lot of previous purchases in Ukraine. And you can see the bulk of their corn imports do come from Ukraine and from Brazil. Now, why are export sales then doing so well? It's because of the pace at which we're selling to Mexico. Better than 200 million bushels ahead of last year's pace. I've talked to some who say this is about to come to a halt. I talked to others who say this is going to continue. My bias is it's going to continue, probably not at the same pace, but I believe it's going to continue. Now, let's look at how this impacts the balance sheet. Not a lot of changes here from the last report. USDA brought its feed usage up to where I was at. I didn't change anything about this balance sheet on my side of the ledger. All I changed was USDA numbers. Now, these export numbers, USDA could, those could really be impacted by Brazil's winter corn crop if it's combined with Argentina's production. If South American production comes in bigger than expected, we could see these export numbers go down, maybe 200-300 million bushels. On the other hand, if they have a failure, we could see them go up. I'm already almost, 150 million bushels below USDA for my new crop corn exports, almost 200 million bushels below the current year. So it could get more bearish or it could get more friendly to the markets. A lot's going to hinge on how this Brazil corn crop matures and develops over the next 4 to 6 weeks. We look at soybean imports by China, purchases. This is actually purchases by China. You can see that we're below every recent year with the exception of the 2019 marketing year. And everyone says that was a Trump trade war. And yeah, that was a factor. But you know what the biggest factor is, in my opinion? Biggest factor was African swine fever. They simply didn't need the soybeans. They were backing up supplies by our estimates, which certainly differ from China's official estimates. They lost 60 to 65% of their hog herd that year. They just didn't need the soybeans. They're getting plenty from Brazil. You can see the plateauing of Brazil's soybean demand. You can see export shipments are currently shipping at a pace, marketing year to date, where shipments exceed that seasonal pace needed to hit USDA's target by better than 30 million bushels. But that's been losing ground, and I expect that to continue to lose ground. Crush continues to be strong after that January number was messed up by a plant going down in the Midwest. But we're seeing overall crush come back strong. And here again, nothing new here. We are continuing to expand. We do have some plants. The technology's still new, folks. And that's one reason we were conservative our estimates and why we haven't had to curtail our estimates near as much as some others have. But it is still growing, and we are making our way there. Would we like it to be faster? You bet. But it is coming. And this is the estimate of crush capacity continuing to grow through 2028-29 marketing year. Here's where the new crush plants are that are going in, along with some of the old ones. And you can see all the new plants in the western part of the Midwest, western part plant. And we're going to see a lot more soybeans kind of probably migrate that way over the next few years. If we look at our balance sheet, again, my export numbers, what's vulnerable? Obviously, it's less than the current year, and I expect that trend to continue for now. But USDA making some significant adjustments in their balance sheet and getting their export number down to about where I'm at now, a little bit below where I'm at. Still not raising a crush estimate. They got to do that yet. That's still a problem. I think that's coming. I think they're going to end up having to. If we look at our wheat balance sheet, there's just plenty of wheat there, folks. No shortage of wheat. And we're looking at variable rate storage starting to climb higher. All that does is tell the world that our system is facilitating us being the residual supplier of the world, of the wheat to the world. We have the storage facilities, and we have a variable rate plan that actually pays people to store wheat. And so those stocks go up. Under my initial scenario there, using USDA's acreage numbers and its yield number, we do see stocks go down somewhat from the current year. Oh, wait a minute. I was looking at the wrong number. I'm sorry. We see stocks go up in all three scenarios. There's nothing bullish about this number. Now, weather could certainly change this. We've got a lot of drought in the Canadian prairies. We've got a lot of dryness in the plains. Right now, the crop looks good. We've got dry areas of the Black Sea, but so far, the crop looks good. If the pattern continues, then we could see supply shrink. Right now, we can't assume that. If you look at stocks, hard red winter wheat supplies are the most burdensome right now in the plains, and the funds continue to maintain their short positions. So what are the take-home points? And if you haven't added your question yet over on the right-hand side, you can still do that. Commodity deflation theme is losing its influence on these markets. So keep your eyes on that. The world is amply supplied with corn and soybeans currently. Excuse me. Today's numbers provide zero incentive to ration demand with higher prices. A strong dollar adds headwinds near term, and reinflation risks continue to rise as a longer term factor. So these are things to keep your eyes on as we go forward. And Victoria, I see we've got some questions that have come in. I'll grab a drink of water and let you read the first of the questions to me, please.
Okay, thank you, Arlan. Yeah, the first question is from Dave. He's asking if you think that USDA should have cut corn and soybean production in Argentina and Brazil.
Well, they cut Argentine corn production by 1 million metric tons. Probably should have done a little bit more, but that really didn't surprise me in Argentina because with USDA's conservative nature, they don't want to be going back and forth. They don't want to overdo it. They know it's still early. So I guess they got the ball rolling with this one. Brazil, a little bit surprised that they didn't make any reductions there. Not more so for soybeans than for corn because it's still early on the corn. I would fully expect them to make an adjustment next month on the corn. On the soybeans, again, they raised their last year's soybean crop up to 162 million metric tons. A year ago, well, maybe a little more than a year ago, it was at the end of the growing season last year. It was at 156. And so it's just amazing how previous year's crops tend to continue to get bigger. And I think that's why they're being so conservative and going lower now. But I still do expect a little bit more of a bump for their Brazil corn and soybeans. And in Argentina, it's still anyone's guess.
All right. The second question we have is from Marco. He's asking, what prices must soy and corn fall in order for us to see a real contraction in planted area in 2025 and 2026?
What price does it see to get a contraction in area? Well, I'll answer it two ways. The first way is, as long as they can cover their variable costs, they're going to grow a crop. And even if you figure it right now and it's below that, the farmer, how he survives the adversity of the farming life is he has an optimistic filter. He always believes things are going to get better. That's what keeps him going. And so the only reason I've heard for reducing corn acres of any significance is that some bankers are refusing to give an operating loan for as much corn as what farmers want to plant. I think that's more anecdotal than anything else. Farmer loves to plant corn, loves to stand by a tall field of corn. That's just the nature of them. And so we'll watch how the weather plays out. Historically, when the weather plays out well for planting, they tend to plant a little bit more. And over the coming week, we're going to see a lot of active planting progress. And that's going to increase in the following week, depending on weather. Right now, it's looking kind of wet, but we'll see. But right now, I don't see anything really to create concerns or problems for this corn crop going forward.
Do you think the 2024 Atlantic hurricane season forecast trumps ENSO's forecasts?
The 2024 Atlantic hurricane season forecast, anybody working on those will tell you that their reality will be different than what the forecast is from a number standpoint, but they hope to capture the actual trend. And I think as warm as the waters are in the Atlantic into the Caribbean and the Gulf of Mexico already at this early date, the expectation is fully that it's going to be an active hurricane season. That means a lot of hurricanes, but it doesn't say where they'll be. We may have a lot of hurricanes hit the coast, either the eastern seaboard or the Gulf Coast, or we may have none or somewhere in between. And forecasters I talk to say, you can't assume because we expect an active hurricane season that that's going to translate into a lot of hurricanes hitting U.S. territory. We simply don't know that. And so while I do believe there are going to be a lot of hurricanes, I don't think we can say with any level of confidence how many will actually hit our coast or impact our cropland.
If Brazilian corn crop reaches 130 million metric tons, what will be the impact on U.S. exportation 2023-2024 and on the U.S. 2024-2025 S&D?
If we would do that, see, that's for the corn, and I'm working on my calculator here. We would add probably 200 to 250 million bushels to the size of the exportable supplies available from Brazil. So I'm going to say 240 million bushels added to the Brazilian supply. And that would be expected to come off of U.S. exports, reducing U.S. exports. On the other hand, if it would fall that, that's running about 5.5 to 6 million metric tons above where our current customer survey is. If it would fall that far below, then you would expect it to add to U.S. exports. So I'm going to say we could either take away or add roughly 250 million bushels to that export target that I have on my balance sheet. That's a potential 500 million bushel swing that has big price implications.
Where do you see the US dollar going this coming year?
Well, if the European Central Bank is able to, let me start off saying, the dollar should go lower under the typical economic policy scenarios. But since we're seeing reinflation pressures now put pressure on the Fed to hold rates where they are, and I still can't rule out another rate hike at some point this year, and the European Central Bank is planning on cutting rates soon, then that makes the dollar the stronger of the two. And that is a problem for the US economy. Now, if we see that push interest rates significantly higher, that's what can throw our economy into a recession. So interest rates at current level are still below the long-term average, but they are putting a stress on business, putting a stress on consumers as well. My bias right now is that the dollar is going to be under pressure as long as Europe is able to follow through on its desire to cut interest rates there, and the U.S. doesn't have to cut rates. Then I think that's going to create more upward pressure on the dollar.
John is asking if you can comment on USDA ending the July cattle report and county yield estimates.
John, it's interesting you asked that question because I'm going to be on a panel with USDA's chief economist tomorrow, and we're going to talk about this. And USDA is also having a listening session on Tuesday that I understand there are people in the industry who are vying for spots on that to speak. I haven't been a part of that as far as encouraging that, but that just, so USDA is going to get an earful. I don't think it's going to matter. I think the frustration for the industry that we're hearing from our customers is this is a time when USDA is spending money on a lot of things, billions of dollars, on projects that do not seem consistent with USDA's mission, but yet they are cutting reports and survey work that is vital to the economic development of the industry. And that is very frustrating to a lot of people in the industry there. I'm just being a mouthpiece of what we're hearing from our customers. So that's kind of where I'm at, and gives a little bit of feel and some of what I plan on saying tomorrow when I'm on this panel with the chief economist.
Tyler is asking, do on-farm inventories of corn and soy in the USA keep the funds from covering their shorts, or do you see the funds more focused on trading the trends or other variables?
Tyler, that's an excellent question. And when at the beginning of my presentation, when I showed the strong correlation between fund positions, fund ownership, and prices for the commodity sector versus inflation expectations, that's history. History has a tendency to repeat itself. History, and you can make an argument whether these commodities serve as good pieces of an investor's portfolio to hedge against the risk of inflation or not. But history says, regardless, that's what the funds do, and history tends to be repeating of itself because fund managers who don't know what a corn plant looks like or a soybean plant looks like love to follow history, and it becomes self-fulfilling. That said, the large supplies that we have, and a much larger supply of them are on the farm, that tends to increase what we call the carry in the market, the premium of the deferred contracts relative to the nearby, as the market says, we don't want your grain now, we're going to pay you to continue to store it. And the funds love to sell that carry. And so that argues for them maintaining short positions in the deferred contracts. So which is going to win out in this case? I think it's going to be some blend of the two, and it's going to come down to, I do think that we're going to see them ease back on their large short positions. I do think it's going to vary by fund. And in the end, I do think it is going to elevate to some degree the level at which the market manages supply and demand. So I do believe that prices can trade at a higher level during times of reinflation than what they would during disinflation. But this is going to be a real test of which one of those forces plays a bigger role this year. And I do think that it tends to limit the downside risk. It does not reduce the downside, no, it does not eliminate the downside risk. Hopefully I communicated that effectively. So excellent question, Tyler, and one I plan on learning from as we go forward as well. Looks like that concludes our questions for today, Victoria, unless you see some that I don't see. And so I'm going to say that questions have come in. The May report, therefore the May webinar, is a big one, perhaps the second biggest of the year. That will have our first look at the 2024-25 balance sheets for the crop year. By that time, most of the winter corn crop in Brazil should have pollinated. We'll have a good handle on the weather pattern for that and for early grain fill. We should have a better handle on the weather pattern for the U.S. Midwest growing season. We'll have a better handle on this reinflation question. I think there's going to be a lot to talk about in that May report. So I look forward to seeing you next month. The date on that is going to be May the 10th. And I hope you'll all join me again for that. Thank you for being with us today. I appreciate it very much. And be safe out there as you're planting your crops this spring for those of you who are on the farm. Appreciate it very much. Thank you.